Picture this. You're scrolling the news and you see the headline you've been waiting for. The Federal Reserve is cutting interest rates. You've been holding off on buying a home and you think this is finally your window. So you jump online to check out current mortgage quotes. And you just stare at the screen for a second. A 30-year fixed rate is sitting at exactly the same number it was before the cuts even started. It feels like someone changed the rules of the game right as you were about to play. But that frustration comes from a widespread misunderstanding of how mortgage pricing actually functions in the real world. Today, we are going to tune out those headlines. Instead, we'll build a 3-step action plan to track the correct metric, calculate your true affordability, and force lenders to compete for your business. The first step to taking control of your buying timeline is realizing one crucial fact: the Federal Reserve is not your personal loan officer. When financial media reports on a Fed meeting, they often frame the federal funds rate like a master volume dial. They make it sound like when the Fed turns that dial down, all consumer borrowing costs automatically drop right along with it. But the federal funds rate is incredibly specific. It is strictly the overnight lending rate that commercial banks use to manage their own liquidity with each other. That is the actual mechanical thing the Fed is changing. Your 30-year fixed mortgage is tied to a completely different benchmark. It is overwhelmingly driven by the 10-year U.S. Treasury yield. Look at this chart. The 10-year yield is set every single day by millions of global bond investors making bets on inflation, economic growth, and the national deficit. The Fed doesn't set this number by administrative decree, and anyone can check it online in a matter of seconds. This creates situations where the Fed and the bond market send opposing signals. Recently, the Fed started cutting its short-term rate, but bond investors looked at sticky inflation data and massive government borrowing, and they demanded higher yields to compensate for that risk. And your mortgage listens to the bond market. When the 10-year Treasury yield climbs because of those broader economic fears, mortgage rates inevitably follow, regardless of whatever the Federal Reserve is doing that week. If you are trying to time your home purchase but you aren't watching the 10-year Treasury yield, you are flying completely blind. Step 2 requires breaking out of a psychological trap that has paralyzed buyers for years, waiting for perfect conditions. People see high rates and decide to pause their lives until those numbers drop. Let's put real numbers to this. This graphic shows scenario A. It's late 2023, and you look at a $400,000 home. With a 20% down payment and a 7% interest rate, your monthly payment comes out to roughly $2,129. Now, look at the right side for scenario B. You decide to wait. Fast forward to 2025, and rates have dipped to 6.2%. But while you were waiting, that same home appreciated by 5%, pushing the price up to $420,000. Your new monthly payment is $2,054. By waiting a year and a half, you lowered your monthly payment by a difference of just $75. In exchange, you had to bring a larger down payment to closing, and you missed out on building an entire year's worth of personal equity while continuing to pay rent. Prices keep climbing because inventory remains incredibly low due to the rate lock-in effect. Millions of homeowners secured 3% mortgage rates during the pandemic. They aren't going to sell their homes and voluntarily double their monthly payment just to move across town. If mortgage rates do eventually drop into the low fives, some of those homeowners will finally be willing to sell, but millions of buyers who have been waiting on the sidelines will also flood the market at the exact same time, unleashing a tidal wave of pent-up demand that drives asset prices up even further. Delaying your purchase strictly to wait for a lower rate relies on the assumption that home prices will stay frozen while you wait. History shows that is a highly risky gamble. There is one more layer to pricing that you can actually control. It's a metric called the mortgage spread. Look at how this is structured. You have the 10-year Treasury yield setting your baseline. The mortgage spread is the extra cushion built right on top of it. This represents the lender's risk premium and their profit margin. Right now, that spread is historically wide. During the pandemic, the Fed aggressively bought mortgage-backed securities to keep rates suppressed. Once they stopped buying, investors demanded higher yields to take on that risk, causing the lender's required margin to expand. But unlike the global bond market, this spread is not a fixed universal number. Different lenders charge drastically different spreads to evaluate the exact same borrower. According to research from the Consumer Financial Protection Bureau, shopping your loan profile across just 2 or 3 lenders can save you tens of thousands of dollars over the lifetime of your mortgage. Here is your exact checklist. Do not just accept the first quote from your personal checking bank out of convenience. Get one quote from that primary bank, a second from a local credit union, and a third from an independent mortgage broker. The mortgage spread is the only piece of the financing equation you have the direct power to negotiate. Make them compete for your business. So here is your playbook. Stop watching the Fed and start monitoring the 10-year Treasury yield. Calculate your affordability based on current local prices, and force at least 3 different lenders to compete on the spread. This brings us to a piece of industry wisdom that helps frame the entire decision. Marry the house, date the rate. Buying today secures your long-term asset price before it climbs any higher. The rate, however, is temporary. If the macroeconomic environment improves and yields drop over the next few years, you always have the option to refinance. Compare that to the buyers who stay firmly on the sidelines. They will eventually secure tomorrow's slightly lower rate, but they will be forced to apply it to tomorrow's significantly higher purchase price. Real financial success in real estate comes from running your personal budget math and understanding the mechanics of the market, not from trying to time a news headline. Drop your target monthly payment in the comments below, and I'll see you in the next one.